Good evening. Good to be here, and a great topic to be talking about. Everybody has an interest in residential, even if they haven't anything invested in it. Because they own a house, they are a fund manager themselves. So we will have something in common. I'm going to talk about three things tonight. Very briefly on who Invista are and what we do. The main body is actually the whys and wherefores about the residential as an asset class in its own right. And if I have persuaded you and you like residential, the best and most appropriate way to invest in it, which I believe is a grouped investment vehicle. So who are Invista? We're the largest listed real estate fund manager in the UK. We manage assets under management of 5.3 billion, 23 client funds, and that actually makes us a very wide, far-reaching fund management house. Not only in the UK, but we've got offices in continental Europe and Far Asia. A team of just under 100. So it is in-depth research teams, compliance teams. Everybody is there doing the overall job with far-reaching talents. Now that's what Invista may be known for. What we're not really known for is the residential side. It's quite a well-kept secret. As Tim said, we manage just over 400 million of residential assets directly. Of that, Investa actually owns 120 million ourselves because we believe in the sector, and that we are hopefully to recycle in future funds going forward. We also manage three indirect vehicles where we actually manage the cash in somebody else's funds as well, and I'll show you one of those tonight, which isn't a great story, and there's a lesson to be learned. So on to the interesting stuff, residential. Why UK residential? As you can see there, £4 trillion market. It is a massive market, the biggest market in the UK, and it dwarfs the other asset classes, commercial equities, bonds put together. It is truly massive. And yet, interestingly, it is the hardest market to actually invest in, unless you want to buy a single house with the estate agent, single flat or house. The availability of funds is very small, unlike commercial, or if you want to invest in equities, you can do it for a very small piece. Residential, you would actually, the only opportunity is really through a buy-to-let investment, where you're using a huge amount of equity, gearing it to the hilt, making it quite a risky product. Also within this massive asset class, like commercial, you've got retail, you've got offices, industrial. You have a similar sort of thing with residential. Everybody thinks of residential as being individual houses, flats, the buy-to-let investment. But underneath that, you've also got ground rent investments, which is secure income. You've got the equity release, life tenancies, which is no income, but big exposure to capital growth. And so you've got a myriad. You've also got housing association guaranteed leases. You've got government-backed leases. In fact, the portfolio we own, 300 odd houses, leased to the Ministry of Defence. You can't get a better covenant than that for 20 years. So that is a cracking asset class, cracking portfolio. The other thing we doesn't get talked about in residential is it is a superb diversifier. As you can see here, has the lowest correlation to the other asset classes, similar to commercial, but you'd expect that because it's still a property class. But 0.9, the most correlated would be -1. That's the maximum score, and that would be something like umbrellas and ice cream, totally unrelated. So to get diversified risk away from your portfolio, residential is excellent for diversifying with equities and bonds. And again, a quite well-kept secret. Then moving on, the other thing is it offers cracking long-term performance. This actually slide has made my life a little bit harder. 6 months ago, it was outperforming year, 3 years, 10 years, 20 years. Because of the last 6 months, equities have caught those. So actually, equities have outperformed, to be fair, residential with a 30% gain. Coming from what is fundamentally quite a low base level, but it has come and beaten residential this year. But in the long run, yeah, residential's there 10 and 15% over the 10 to 35 years. So that's one thing. What an investor looks for: good returns, good long-term returns. But what about risk? And then we don't look at this enough. So let's look at the volatility. Again, I'm quite surprised by this. It's actually only slightly less volatile than commercial. I was expecting commercial to be a lot more volatile. We know commercial values have gone down 40, 50% in the last year, but they're recovering faster than residential again. But there we have equities right up there and bonds slightly higher. Now, to help explain that, we've layered these two together, the risk and the return together. Next slide. And if there's one message I want to take home tonight, it's this slide. This is such an important slide. To explain it, I'll just get up here. Along the bottom scale, we have the volatility. So low volatile, low risk, high volatility on the right. On the left scale, we've got the performance returns, 0 going to high returns. So here, high risk, low return, not where you want to be as an investment manager. Up here, high return, low risk. That is what we talk about. You know, at valuation school, you go, it's location, location, location. Investment management school, fund management school, it's high return with the lowest risk. And we've plotted on that the relative return for residential on the 10, 20, and 35 years. Interestingly, on the 35 years, it's only slightly lower than equities. You'd expect equities to be, high return, high risk, right out there. But that's to be there, residential, with a low level of risk, is spot on. And on the 10 years and 20 years, it's a no-brainer. Why aren't people investing in residential on a large scale? Why aren't these institutions investing in this asset class? They have these measures, the Jensen measure, Sharpe and Trainer, of measuring risk-adjusted performance. And these are their measures, not ours. But no, until to date, we have the lowest level of institutional investment in the UK than all our European and American counterparts. Okay. So why not institutions? I'm just going to not go through all these individually. I haven't really got enough time. I'm just going to focus on a couple of them. Concerns of scale. Yes, that is a true issue. Unlike the commercial market, if you had a £1 billion fund, you would have difficulty spending it in a relatively short period of time. I'm not saying it's impossible, and you need to know what you're doing, but it is harder than commercial. The other one I would say, and this long in residential, I hear this all the time, and I just don't buy it. By virtue of an individual owning their house, that they're long in their sector. If they know the market's going to crash, are they going to get out of residential? Are they going to sell their house, move the family house, and get into bonds? No. Generally, owner-occupiers will stay in owner-occupation until they go into terminal care or are post-mortem when they die. And they don't benefit from the cash. The family or the estate benefit from it. And that is fact. So it is not, as you say, they're not long in residential. It's like my wife, she's got gold everywhere. Does that stop me from benefiting in the benefits of gold at the moment? No. I still want to be able to invest in it. Well, I tell her she hasn't got lots of gold, but I use that as an argument. And finally, lack of talent. I'm puffing myself up a little bit here. Starting off in university, when I was reading urban estate management, I was the only one in the entire class who had a modicum of interest in residential. Everybody else wanted to be commercial surveyors. That was where you were meant to go. So there isn't that education in the industry. And secondly, there isn't sort of the talent pool in the institutions. And I was at a conference, and I won't say which fund management house what it was, but they were talking about residential. And they had concerns of investing in it because the tenants paying them the rent, we were on tenancies of 6 to 12 months. They had no recourse if they upped and left and didn't pay their rent. And so they said that for that level of risk, they wanted a higher level of return to compensate for that risk. Now, in my mind, that's completely barking, because of the main portfolio we run, it's 1,400 units. Today, I looked at it today, we have 32 voids. It was pretty much that last month, it was pretty much that the month before, and it's going to be that next month. And that's just a 2% void rate. Because we've got diversity with the number of units, it is not a risk, it's diversified out. And therefore, we don't need to see the level returns that this other house was actually trying to achieve and won't achieve, and they won't be investing in residential. So that's why not the institutions.